Welcome to Sager and Crow Wealth Management with Canaccord Genuity. I'm Kathy Sager, and this is my partner, Darcy Crow. We're here today to bring you number 2 in our continuing series of Ask the Expert. And today we have the distinct privilege of having Ryan Gill, who is an accountant who will talk to us about the cross-border taxation of real estate holdings. And Darcy, would you like to discuss more about Ryan and his background?
Absolutely. So I'll go ahead and introduce our guest today. So we're thrilled to have Ryan Gill joining us. He is a partner with KPMG's tax group. So Ryan practices in the area of tax planning and compliance for individuals, estates, and trusts in both a US and cross-border context. So he advises individuals on both sides of the border on tax matters related to their residence, compensation, investments, which will include real estate, retirement plans, estates, gifts, and expatriation. So Ryan, you come with a wealth of expertise, so thank you so much for joining us today.
Yeah, no, happy to be here.
Great. So I'll just give an overview of sort of the topics we want to hit on today, and then Kathy will dive into the first question that we have for you. So we'd love to talk about forms of ownership. If someone's looking to buy a property or they own a property, what do those different forms look like? We'll talk about both, tax implications from Canadian and US tax issues. Then we'd love to get into disposition of cross-border assets, and then lastly, just touch briefly on US estate and gift taxes as well.
Okay, sounds good.
Thanks for your time today, Ryan. What we're going to start with is actually quite self-serving for me, because my husband and I found ourselves in this exact situation a few years ago. We purchased a condo in Maui, and we bought it in personal name, which I'm now thinking was maybe not the best way. We have one child, and we hope to leave the condominium to her as part of the estate. So knowing that it's in personal name now, what other ways of ownership would you recommend? And if something is held in personal name by a client or by ourselves, would you recommend changing that to, say, a trust at this time?
So that's a good question, and that comes up all the time. And for you, actually, personal ownership might be the right case. So there's a bunch of factors that you have to look to. So one is you have to look at, what's your marital situation? Are you married? You mentioned you are, and you have a daughter that you want to pass the property to. 2, what's the value of the property? 3, what your net assets are, because the estate tax formula is based on that. So those are the 3 main factors we look at when determining forms of ownership. So for if you already own the property, putting it into a trust is usually not advisable, because you'll either incur Canadian income tax or US tax when you put it into the trust. Canadian corporation is it's an idea that works for rental properties, but not for personal use properties. So your property in Maui, do you use it personally, or do you rent it out?
It's a mix.
Okay.
We do both.
Right. So the personal use time, if you put it into a company, that would actually be a taxable benefit to you. So it wouldn't be worth it to put it in a company. And the other option we look at is a partnership. You could put it into a partnership, but for that structure, we're looking at like properties that are usually valued at $3 million or more, so large properties. So if you own it personally and the value of the properties, I'd say less than $2 or $3 million, and if your combined net worth is right now, the estate tax exclusion is like $11 million, it's going to go down to $6 million. Personal ownership is usually the best answer in those situations, and passing it on in terms of to your daughter, the best way to do it is actually not gifting it to her before you pass away, but rather passing it away, passing it through your estate to her. Because what happens is, if you're below that, it's going to be $6 million in 2026, but if you're below that $6 million net worth range, there's no estate tax when you pass away. You have to file an estate tax return though. And then also the cost base of the property is increased to its fair market value for US tax purposes. So you get a free cost base bump. Whereas if you gifted the property to her before you pass away, there's US gift tax on that, and it's just a much worse tax result. So if you look at all those, I mean, if you look at the different scenarios, I think the ownership structure that you're in right now might be the right one for you. But you'd have to look at what I said, as I said, the value of the assets, what your net worth is. So you'd have to accompany everything together.
I think that's clear. I think we might have just stumbled onto the right answer. So thank you for that, Darcy.
Yeah, no, that's great. Thanks, Ryan. I think that that gives our viewers, the three main things that they need to be thinking about, and then of course, I think the advice needs to come on their, personal, unique situation. So that's really helpful. Thank you. So let's chat about a little bit more about U.S. tax implications, and specifically in the instances, similar to what Kathy's is, where people might use a property a couple months of the year personally, but then other times of the year might be renting it out. So can you just talk a little bit about, from the US side, tax implications on, rental income specifically?
Right. So rental income, since it's a U.S. property located in the U.S., and if you earn rental income from it, you're taxed on that income, whether you own it personally, in a trust, in a Canadian corporation, or in a partnership. So it's similar to the rules here. You report the rental income. You can claim similar expenses, property taxes, mortgage interest, utilities, and you actually have to file a tax return in order to claim the deductions. And you have to file it in the first year that you get rental income, even if it's a loss. We always tell clients to file returns, just because what happens is the losses, you can accumulate them over the years and use them when you sell the property to offset your gain. So in the first year you rent it out, we recommend filing a federal tax return, US tax return. And then if your property is located in, for example, Hawaii, you would file a state tax return as well. And then you make an election that you want to be taxed on the net income from the rental property. And then in the U.S., everyone here might be familiar with the concept of depreciation, depreciating your property in Canada for tax purposes. In the U.S., they have the same concept, but depreciation is mandatory in the U.S. So depreciation, we find, often results in a tax loss for clients when they claim it on their returns. So the rental income is taxable in the U.S. Federally, and it's taxable in the state as well. And then it's also taxable in Canada because we have Canadians owning rental property in Canada. So what Canada allows is you to take your U.S. tax and claim it as a foreign tax credit in Canada, so you're not double taxed on the income. So that's how it works, like in a nutshell, in terms of taxing rental income on your U.S. property.
So Ryan, would that have the impact of mitigating double taxation? Are there any other tax implications as Canadians that we should be aware of?
So the rental income is one, and then the other is when you sell your property. So when you sell your property, off the bat, they'll take withholding tax off the U.S. withholding tax off the sales price. So if you sell your property, say for $1 million, with like 15% off the top, you can request to reduce the withholding. We have to do that before the sale closes. Or what happens is you file your tax return in the next year, you pay your tax, and you'll get part of that withholding tax back as a refund when you file your tax return. That gain is also taxable in Canada because we have Canadians owning real estate in the US. So Canada, same concept, will give you a tax credit for the US tax you paid on the gain to mitigate and double tax when you pay tax on the gain in Canada. So that's how the gain generally works. And then another important thing is if you own that property personally, in the first year you rent it out, I just want to back up, you actually have to get a US tax ID number, and you have to get it with the first tax return you file. And now it's been hard for our clients to get it because of COVID. So they've had to jump through a lot of hoops to get their passport certified and get their tax ID number. But that's another important thing they have to get when you file your first US tax return.
Okay, that's great. So, and we do talk to a lot of clients that are, looking at they're at that stage of life where they're, perhaps not using their property as much or thinking about disposing of it. So, in terms of those withholding taxes, can you just give us a high-level overview of sort of what that amount is, also timing? I know from a family experience, we were almost a year in terms of getting some of the withholding tax paid back. So can you just give us a little bit of an overview about, what people can expect from that process?
Right. So at the federal level, it's 15% off the top, the sales price. And then some states have their own withholding. For example, Hawaii has its own withholding, and then California does. So what happens is when the sale closes, the withholding tax has to be paid within a certain amount of time, usually 20 days after the sale date. And then the IRS, that money is remitted to the IRS. If you don't have a gain on your property, or if your gain is smaller than the withholding tax, you can request to reduce the withholding tax. You have to file some forms before the sale closes. So what happens then is, say if you have a property that sells for $1 million, say there's no gain on it, but there's $150,000 of withholding tax that has to be paid, right? And then you're just tying up $150,000 with the IRS for a year, which you don't want to do. So what you do is you file the withholding certificate application, and you request to get that $150,000 right away, so you would not remit it, so it would not go to the IRS. So that gives you, usually they complete that process in 90 days. So from the date of sale out 90 days, you could get that $150,000 back from escrow in your pocket. But say if you don't file that form, the withholding certificate, then say if you sell your property in January, let's say January 2021, you're looking at getting back the $150,000 likely in 2022 sometime, like say April, May, June, July 2022, whenever the IRS gets to processing that tax return. So that's so not applying for that withholding certificate to get the money back, within 3 months can leave you out more than a year in terms of time.
Yeah. And I think at that point we'd actually run into a government shutdown. So again, unexpected delays. So we always, when we talk to people about their financial planning, in terms of, planning and leaving some flexibility for those timings. And the last thing is, I know, foreign exchange is something that we need to think about as well in terms of how we're calculating capital gains. Is that correct?
Oh, absolutely. So in the U.S., it's simple. The property is listed in U.S. dollars, but we've had clients in the past few years, I'd say the past 4 or 5 years, who have gone to sell their U.S. properties, but then they bought it when the exchange rate was at par. But then now it's been 130 for a while, and they go and sell their property, and they won't have much of a gain in U.S. dollars, but they come back when we calculate the gain for them in Canadian dollars is a big gain, right? Because because of the dollar fluctuation. So that is something to watch out for always. Before you go to sell a property, you'll know the gain in US dollars, but it's important to calculate the gain in Canadian dollars as well.
Great. Ryan, you also mentioned something about gifting earlier, that was not a good idea. Or at least that's what I think I heard you say. And a lot of clients think gifting could work for them to mitigate estate taxes. So can you talk more about gifting the properties?
Right. So the way gifting works is in the US, they have a separate tax system for gifts. It's the US gift tax system. So what happens is, if you're a Canadian, you don't have any ties to the US other than your US property. If you gift that property to anyone, even your spouse, there is a gift tax on it. And then none of the exemptions available under US tax law are available to Canadians. Like the exemptions are very limited. So you have a gift tax, and the gift tax applies on the value of the property, even if it doesn't have a gain. The gift tax can get up to 40% of the value of the property, so it's quite substantial. So that's how it applies in the US. But then if you were to gift your property to your daughter, there would be Canadian income tax as well, because when you gift something to someone other than your spouse, there's a deemed disposition for Canadian tax purposes, and it triggers Canadian tax. So if there's a gain on your property, you end up paying Canadian tax, income tax, and then you pay US gift tax. And those two taxes can't be offset against each other. So you have double tax when you make the gift. You have Canadian income tax on the gain, and then you have US gift tax on the value. So you're paying tax twice on the same asset. So our bottom line answer to anyone who wants to make or considering making a gift of US real estate is to not do it. It's better off to die with the asset just because the taxes match, you get a cost-based bump, or sell it during your life if you want to get proceeds.
Great. Well, that's very helpful. So I think that touches on a lot of what we wanted to get to today. Thank you so much, Ryan, for joining us. It's certainly a complex topic. So you've got a wealth of experience there, and I'm sure it was very informative for our viewers. So thank you so much for taking the time to join us. And for viewers that might have some follow-up questions, Kathy and I are here. Please reach out at any time, and we would love the opportunity to discuss further with you. And our viewers, thank you for joining us. Keep tuned in. We're going to be launching several additional webinars to come. Everything from life transitional events, wealth transfers, perhaps portfolio management. So please tune in. You can either call us directly to ensure that you're going to receive those videos, or visit us at sagerandcrow.com and just sign up to make sure that those videos will come directly to you. So thank you so much, Ryan. It was a pleasure to have you with us today. And everyone, we look forward to seeing you again soon.
Yeah, thank you, Darcy. Bye. Thanks for the opportunity. Take care.
Thank you. Have a wonderful day.
You too. Bye-bye.